Okay, so for chapter 8, let's look at the assignment. So here, um, let's start our work here. Sorry, I'm just organizing things away from where I'm going to write here. Um, so we start off here with a short answer question. That's perfect. Um, so here we're looking at benchmarks being met via operational excellence or by taking real actions to maintain accounting appearances. Why is the latter approach not the desirable one? So this one shouldn't be too difficult, right? The idea would be if you're working that hard to hide things, then it must be pretty significant what you're trying to hide. So um, that would be kind of the nature of your answer here is that um, we would see that operational excellence in things like an operating margin that's higher, a cost of goods that's perhaps lower, other sorts of kind of benchmarks basically of where the firm is becoming more efficient and a better steward of capital. Um, how would we see accounting appearances? You'd see that if you see weird things going on in terms of how inventory is being managed. Um, if you see a lot of non-recurring um, revenue that suggests maybe even kind of a selling of operations or other things that are designed only to maintain a higher profit level. Okay, so then um, in looking at the um, incentive compensation plans is to plan within a plan. So the first one is the um, plan within a plan, and then the other one, and this is sort of definitional, would be our bottom up plan. This is just pretty easy. There's not a lot to really explain here because this is definitional. Okay. Number 3, company's A interest ratio has fallen below the level required by its lender. Um, if the interest ratio has fallen below that level, what can the lender not do? Um, can it demand repayment of the loan? Yep, that would be typically something that would be one of the conditions. Gain representation on the company's board of directors. Um, so for this one, you really would have to hope that you had a loan document that kind of spelled out that ability to have that. Um, but um, it's it'd be pretty rare that you would see that kind of thing, and the reason why is because remember the board of directors primarily serves the shareholders. And in this case, you'd be talking about the bank, basically the lender. Um, but it's possible. Replace the CEO of the company? No, that one's an absolute no. Why? Because the CEO is appointed by the board of directors. So the only way you could remove the CEO of the company is if the lender did gain representation, which could happen. You'd either have a loan document or the bank could convince um, shareholders and say, if you don't put us on the board, we're going to demand repayment of the total loan. And the board of directors may be forced to add bank representatives on the board of directors, but they wouldn't be able to directly replace the CEO. That is solely the responsibility of the board of directors. Veto payment of a dividend. Now there's no veto powers, so it's got to be this. I'm hoping. It is. Thank you. Which accounting choice would not be used to reduce the likelihood of a technical default? So keep in mind, a technical default typically is referred to as basically missing an interest payment, a payment that was required. It's called technical default because typically, once you have a default, you typically have a period of time where you could still make payment and things would be okay. Um, Inventory valuation method. Let's just start from the bottom up. Inventory valuation method. Um, that one could be used to reduce the likelihood of a technical default depending on how you value the inventory. Management compensation plan. That's not an accounting choice. So I'm thinking it's this because this is not an accounting choice. Bad debt provisions, that's an accounting choice. When to sell assets, that would also be an accounting choice depending on how you value those. So I think it's going to be management compensation plan. It is. A typical rate formula for a public utility. So typically, what this is definitional, so there's not a lot I can really add here to this, but typically it would just be your operating costs, your probably pretty sizable depreciation given the high capital investments that are in um, a public utility, and taxes. So these would be what basically needs to be covered by the rate. And so this is definitional. You wouldn't be doing advertising. Um, why would you need a rate to cover revenue? It's the same thing. And then operating costs, bad debt provisions, and depreciation. Bad debt provisions, that's an asset choice. That's not a ongoing concern choice. Um, so public utilities typically have shareholders, and those shareholders would handle that kind of thing. Which statement best describes the technical? Well, I just already defined it, so let's just talk about it more thoroughly here. It's like I'm predicting. It's like I have a crystal ball and I'm just predicting what it's going to ask. Well, also because I chose the question, so that also probably figures into it. Um, so here, can't be this. You would need to have some covenant being violated in some way. So it can't be this because you need a violation of a covenant to be in a default. Um, the borrower violates one or more loan covenants but has made all interest payments. Well, remember, the bank doesn't want to just get back interest. It also wants to get paid back the principal. So, in terms of a technical default, it is true that you would have one or more loan covenants that aren't being met. But if it's not making the principal payments, that's just a default. That's not a technical default. You see, what you need to have going on here is you need to have both the interest and the principal being paid, but some other covenant being violated, such as a um, cash to debt ratio or some other ratio that's within the loan document. So all interest and principal payments made, some covenant being violated that's in that loan document. Many loan agreements have financial covenants that rely on basically what kind of accounting principles, that would just be our gap, our fixed gap. That's just definitional. And hopefully this one's a pretty easy one, because obviously they want fixed gap because they don't want any ambiguity. In the utilities industry, image advertising and consumer safety advertising, how would you treat those for a utility industry? So, just kind of as I was saying before, these utilities, is that something in terms of, who's going to cover that? Well, customer safety, that can be also paid for by the rate holder. So it wouldn't necessarily be paid for by shareholders. It would probably be shared by shareholders and customers. So it can't be either one of these solitarily. It's probably going to be shared by both. Is it treated as a operating um, expense? And like, I guess so now, if it's an operating expense, which it is, under which accounting principles is it an operating expense? And it's an operating expense under GAAP. So this is definitional. Okay. Compensation practices for executives. Where would we find a discussion of that? Um, So, 10K, 10Q? Nope. You're going to find your balance sheet, cash flow statements, things like that. Annual report? Not likely, although possible. It could be there, but it's not likely. It's going to be in your proxy statement. It doesn't say it can't be in your annual report, especially in today's era where executive compensation has become much more important. But in terms of legally, you're going to see that in the proxy statement. Okay. Bank's estimated bad debt expense associated with loan receivables. So, what do we? How do we see that in a bank's balance sheet? Um, if because it's an estimate, that's going to be our provision. So it's our provision for loan losses. Um, it's not a charge off because we are estimating. A loan charge off is actually what happened. So if you deduced it down to both B and D, or the second option and the fourth option, the difference between the second and the fourth is this is what we estimate it to be, this is what it actually is. Allowance for loans? No, that's actually what you're trying to lend out. Accumulated loan loss? No, because this is already known. So a loan loss provision. With respect to executive pay, which of the following is not correct? Um, I'm already going to just, I don't even need to read this too closely here. Um, I see a number and I already know it's not true. There is nothing, there are no regulations, guidelines, laws that dictate executive pay. So I already know what the answer is here. Doesn't even, I don't even have to read the rest of these. This one is, once you see a number, you know that that is the incorrect one. Which of the following statements does not reflect the provisions of ASU 2016 for the fair value measurements? So, although this although this may seem a little bit technical to kind of ask something like this, it is pretty important because what it does definitionally speaking, is it says to us that we have to use the fair value option when we're looking at the liabilities. Um, and that allows us, um, because we're looking at the fair value of the liabilities, that's going to allow us then to see the fair value of the credit worthiness. So we know it can't be this, because that's the whole point of ASU 2016-01, is that we are able to get that a fair value is applied. Requires an entity applying the fair value option to its own liabilities, recognize net income and change in fair value attributable. Yeah, that seems. Oh, sorry, it's not. Okay, let me just think of the definition here. Okay, so we know this one is true. Requires an entity applying the fair value option to its own liabilities to recognize another comprehensive income, not net income, to change in value fair value. That's also true. Requires an entity applying the fair value option to its own liability to recognize a net income. Ah, there we go. Okay. Um, it is applying the fair value option, but it can't. It's for everything other than the net income. So it's a comprehensive income, not net income. So I think it's this, because this is true. It simplifies the impairment assessment of equity. Okay, yeah, and so this is true. Sorry, I had misread this before. So what this is saying is that ASU 2016-01, what it does is it makes it easier to assess impaired equity investments when you don't have a fair value. That is true, because it tells you how to approximate that fair value. That's a tricky one. You wouldn't see something like that on the exam. It's a bit tricky. Covenants that place direct restrictions on managerial decisions. Um, we basically have, we're looking for a covenant here. So it's not negative restrictions or affirmative restrictions. We're really looking at negative covenants or affirmative covenants. And if it's restricting a managerial decision, that would make it a negative covenant. The restrictions, that doesn't make any sense. Based on a comprehensive survey of U.S. companies, what is the way that we determine the performance of senior executives? Okay, so typically what we see it is it's judged on net income or revenues. That's typically the most common way, and this is just kind of definitional. This is just coming from the book. Typically, it's the easiest way, and there's not a lot. It takes into account a lot of different variables. So net income or revenues would be our best way to assess the performance of an executive. Okay. In the banking industry, ratio of investor capital gross assets as defined by the RAP, what is that going to be? So for here, this is also definitional. In the banker industry, typically what we're going to look at is if we're looking at investor capital divided by gross assets, that's typically, is the capital that we have adequate? Hence, the capital adequacy ratio. Sorry, for these definitional ones, there's not a lot for me to explain because you kind of have to um, know the definition to be able to talk about it. Why do loan agreements often contain covenants that are tied to accounting numbers? So, in this kind of answer here, you're really just talking about the fact that the bank doesn't work in the firm and it only has access to certain pieces of information. One of those being accounting numbers that it can somewhat rely on. So, because these are standard accepted principles, these accounting numbers, um, it allows managers to not have that much wiggle room to try to make it seem like a rosier picture than it really is. And it makes the bank be somewhat assured, pretty inexpensively, that it's being told the truth. That's kind of how I would answer it. Which of the following does not properly represent the relation of tax and GAAP accounting? So here, this is really, um, when we're talking about this, we're basically talking about, uh, which items, for instance, in our inventory and whatnot, are we going to count when we're looking at our taxable income? And what we know there is that you wouldn't use, because it would be deceptive, you wouldn't use, if you're using FIFO for financial statements, you wouldn't be doing that. Um, you wouldn't be using that inventory method because it results in lower taxable income. Um, that would not um, that would not um, reflect the way that tax and GAAP accounting are related. Um, as you can see, you can use whatever accounting method you deem appropriate. You just need to, um, for accounting principles, those principles are going to be different than what the taxing authority has. So, um, so it's true, right? So this part is true. Accounting methods used for tax are permitted to differ from GAAP rules. Yes, absolutely true. You get a little bit more leeway, to be honest, with GAAP than you do typically with tax. If LIFO is used for taxes, LIFO must also be used for uh, GAAP. Yes, that you would want to have some of that consistency, at least for inventory valuation. Again, you wouldn't see that consistency. It's not necessarily that using first in, first out would get you a lower taxable income because it depends on the nature of the thing that you're selling. GAAP and tax depreciation expense will rarely be equal. Eh, um, they typically are the same. The depreciation of your capital expenditures. Oh, sorry, I didn't even. So I think it's this. Yes. Consistent with IRS Code 162, companies were able to deduct non performance based compensation for a single executive to the extent that it didn't exceed $1 million. So now, what is the limit under um, the new tax cuts act? Well, I'm not trying to be political when I say this, but it was obviously signed by Republicans, and one of those Republicans being a highly compensated former CEO Donald Trump. So yeah, it was eliminated. That one I didn't know for certain. I knew it wasn't going to be decreased, so I was kind of stuck with these, and I suspected it was eliminated because you might as well do it while you're in power that way. Which of the following did not contribute to the 2008 the 2008 financial meltdown. Okay, so for here, um, speculative bubble drove up prices. That is true. The issuance of high risk. That's true. The packaging and bundling of traditional mortgages. That's true. Increase in traditional third mortgage. Yeah. So if you've even seen the movie The Big Short, it's basically a description of how these three bottom things did cause the problem. It wasn't your typical old-fashioned 30-year mortgage person that was causing the problem. Okay. Bank regulators have powerful weapon to ensure compliance with the minimum capital guidelines. What can they do? Well, I guess what's the one thing that they cannot do? Um, so again, typically, um, when you're talking about a bank regulator, what can a bank regulator force a non-complying bank to do? It typically is not going to get involved in the board of directors because remember the bank is a corporation owned by shareholders, but it's also a entity that's regulated by the banking authorities. You don't want to mix those two typically, so that would be kind of a shareholder activity. The rest of these are what a regulator would properly do. When faced with falling short of a desired earnings target, a financial executive, what would a financial executive not do? Um, so the biggest thing that you wouldn't want to see happening is this, right? You don't want to get involved in timing when you take an accounting charge because then you're massaging, you're manipulating the results. These other activities are activities you would do to just control costs, which is totally fine. But you don't want to make the earnings target more reachable um, by just taking an accounting charge. That wouldn't be right. Okay, and then the last one. Banks have failed to comply with regulations, including the failure to maintain an adequate adequacy ratio. What's going to be their problem? Um, Incarceration of officers? No. It's not really it's not a crime unless you're doing something to actively do it. It's not a crime. Do they face higher costs? They do. So that's one possible option here. So if they fail to maintain an adequate capital adequacy ratio, would that mean mergers and expansion of services? No, that would be exactly the wrong thing to do. And would it face lower costs? No, the cost would be higher by definition because it's a now riskier business. Okay, so a little bit more definitional in this chapter. We're not seeing as many numbers being calculated, so that's a little bit to my um, dislike, but it's a pretty important chapter where the definitions are quite important. Um, so hopefully this kind of helps you understand walking through these questions step by step.